China's household savings patterns are undergoing a fundamental transformation that could reshape global commodity markets in ways not seen since the nation's initial economic liberalization. With approximately $18 trillion in household deposits sitting in Chinese banks as of late 2025, representing roughly 90% of GDP, any meaningful shift in asset allocation preferences carries profound implications for global markets. The traditional flow of Chinese household savings has been heavily skewed toward real estate, which has historically represented 60–70% of household wealth. However, structural changes in China's property sector, combined with demographic transitions and evolving capital market access, are creating conditions that may redirect portions of this vast savings pool toward alternative assets, including precious metals. Real estate crisis as a catalyst for asset reallocation. China's property sector, which peaked in 2021 with sales volumes exceeding $2.5 trillion annually, has contracted significantly. Major developers including Evergrande and Country Garden have faced liquidity crises, while new home sales declined by approximately 25% in 2024 compared to 2021 levels. This contraction represents more than a cyclical downturn. It reflects a structural shift in how Chinese households perceive real estate as a store of value. The government's housing is for living, not speculation policy stance, implemented through various purchase restrictions and financing limitations, has fundamentally altered the risk-return profile of property investments. With rental yields averaging below 2% in major cities and capital appreciation prospects diminished, Chinese savers are increasingly seeking alternative vehicles for wealth preservation. The search for alternatives is occurring against a backdrop of modest deposit rates. Chinese banks offer savings rates typically ranging from 1.5% to 3% annually, which often trail inflation expectations, creating negative real returns that erode purchasing power over time. Like this, demographic pressures and savings behavior, China's aging population adds another layer of complexity to household savings dynamics. With the working age population beginning to decline and dependency ratios rising, older Chinese households are shifting from wealth accumulation to wealth preservation strategies. This demographic transition typically correlates with increased demand for assets perceived as stores of value, particularly during periods of currency or inflation uncertainty. The one-child policy's long-term effects are now materializing in household financial planning. Adult children, often supporting multiple elderly relatives, are seeking investment vehicles that offer both liquidity and value preservation. Traditional bank deposits, while safe, may not adequately protect against inflation over extended periods. Chinese regulators have gradually expanded domestic investors' access to international markets through programs like Stock Connect and Bond Connect. However, direct investment in physical commodities remains limited for retail investors. This constraint has led to increased interest in domestic commodity-linked financial products, including futures contracts and exchange-traded funds. The Shanghai Gold Exchange has seen substantial growth in retail participation, with individual investor accounts increasing by approximately 15% annually over the past 3 years. While gold dominates Chinese precious metals interest, silver's lower unit price and industrial applications have attracted attention from younger investors seeking portfolio diversification. Chinese domestic silver ETFs have experienced notable inflows, though volumes remain modest compared to international markets. The China AMC Silver ETF, for instance, has grown its assets under management by roughly 40% since early 2024, indicating emerging retail interest despite the relatively small absolute amounts. Silver market structure and Chinese demand implications. Global silver markets operate with fundamentally different dynamics than gold, creating unique vulnerabilities to demand shifts. Annual silver mine production approximates 850 million ounces, while industrial consumption accounts for roughly 60% of demand. This industrial dependency creates price elasticity that differs markedly from gold's primarily monetary functions. Chinese industrial silver consumption already represents approximately 15% of global demand, driven by electronics manufacturing, solar panel production, and automotive applications. However, investment demand from Chinese households has historically been minimal, representing less than 5% of China's total silver consumption. A modest shift in Chinese household asset allocation towards silver could create disproportionate market effects. If Chinese households allocated just 1% of their bank deposits to silver-related investments, this would represent approximately $180 billion in potential demand. Given global silver's annual mine production value of roughly $25 billion, even a fraction of such reallocation could significantly impact pricing dynamics. Supply-side constraints and market liquidity. Silver's supply profile amplifies potential demand-side pressures. Unlike gold, where central bank holdings provide a substantial above-ground inventory buffer, silver inventories are more constrained. Industrial consumption permanently removes silver from markets, reducing available stocks for investment purposes. Major silver ETFs globally hold approximately 650 million ounces, while COMEX warehouse stocks fluctuate around 400 million ounces. These inventory levels, while substantial, represent only 6 to 9 months of global consumption. Sustained investment demand increases could create supply-demand imbalances more readily than in gold markets. Chinese domestic silver storage and delivery infrastructure remains underdeveloped compared to gold facilities. The Shanghai Futures Exchange offers silver contracts, but physical delivery volumes remain limited. This infrastructure gap could create bottlenecks if Chinese investment demand materializes significantly. Historically, silver prices have demonstrated high correlation with gold, typically ranging between 0.7 and 0.9. However, silver's industrial applications create additional correlation channels with industrial metals and broader economic cycles. Chinese economic growth patterns, given the country's manufacturing dominance, particularly influence silver's industrial demand component. If Chinese household savings flows towards silver increase substantially, this could alter traditional correlation patterns. Silver might exhibit stronger correlation with Chinese monetary policy and domestic economic conditions, potentially decoupling partially from gold during periods of divergent Chinese and global economic performance. The yuan's exchange rate stability becomes crucial in this context. Silver purchases by Chinese households would likely occur in yuan-denominated products, but underlying silver prices reflect dollar valuations. Currency fluctuations could amplify or dampen Chinese investment interest, depending on yuan's strength relative to the dollar. Chinese financial regulations continue evolving regarding household investment options. Authorities balance capital account liberalization with financial stability concerns, particularly following various market disruptions, including the 2015 equity market turbulence and peer-to-peer lending sector collapse. Precious metals occupy a unique regulatory position, often viewed favorably by authorities as they don't create direct financial system risks while providing households with inflation hedging options. However, rapid speculative activity in commodity markets could trigger regulatory responses, potentially limiting access or imposing transaction restrictions. The government's broader goals of financial market development and yuan internationalization may support expanded household access to commodity investments, including silver. These policy objectives could facilitate infrastructure development and product innovation in domestic precious metals markets. Several factors could catalyze increased Chinese household interest in silver over the next 12-24 months. Continued real estate market weakness, potential yuan depreciation pressures, or inflation concerns could accelerate asset reallocation trends. Additionally, younger Chinese investors, more comfortable with non-traditional investments, represent a growing demographic segment. However, significant barriers remain. Cultural preferences heavily favor gold over silver in Chinese investment traditions. Real estate, despite current challenges, retains strong psychological appeal as a tangible asset. Bank deposits, while offering low returns, provide guaranteed principal protection that remains attractive to risk-averse savers. The probability of meaningful Chinese household silver demand emerging appears moderate but rising. Economic disruptions or financial market volatility could accelerate these trends, while continued economic stability might preserve traditional savings patterns. Should Chinese household savings flows towards silver materialize even modestly, global market dynamics would likely shift substantially. Price volatility could increase as retail investment demand layers atop existing industrial and institutional flows. Regional price differentials might emerge if Chinese domestic infrastructure can't efficiently integrate with global markets. Mining companies would face altered demand patterns, potentially justifying expanded production capacity. However, silver's byproduct nature, roughly 70% comes as a byproduct of other mining operations, limits supply responsiveness to price signals. For international investors, monitoring Chinese household savings patterns, regulatory developments, and infrastructure expansion in domestic silver markets could provide early indicators of potential market disruptions. The scale of Chinese household wealth, combined with silver's relatively small market size, creates conditions where modest behavioral shifts could generate disproportionate market impacts. The intersection of China's structural economic transition with global commodity market dynamics represents one of the more significant macro-financial developments warranting careful observation by precious metals market participants. Historically, silver prices have demonstrated high correlation with gold, typically ranging between 0.7 and 0.9. However, silver's industrial applications create additional correlation channels with industrial metals and broader economic cycles. Chinese economic growth patterns, given the country's manufacturing dominance, particularly influence silver's industrial demand component. If Chinese household savings flows towards silver increase substantially, this could alter traditional correlation patterns. Silver might exhibit stronger correlation with Chinese monetary policy and domestic economic conditions, potentially decoupling partially from gold during periods of divergent Chinese and global economic performance. The yuan's exchange rate stability becomes crucial in this context. Silver purchases by Chinese households would likely occur in yuan-denominated products, but underlying silver prices reflect dollar valuations. Currency fluctuations could amplify or dampen Chinese investment interest, depending on yuan's strength relative to the dollar. Chinese financial regulations continue evolving regarding household investment options.